Welcome back, everyone, to the deep dive. I think it's safe to say a lot of us are interested in the world of quantitative trading.
Definitely a hot topic.
So we're going to take a deep dive today using some really cool sources.
Oh,
We've
nice.
got some excerpts from Lars Kestner's book, a collection of academic papers we've gathered, and Greg N. Gregorius' handbook on high-frequency trading.
Sounds like we've got a lot to cover.
Yeah, I think this will be a good one. We're going to explore some fascinating stuff. How our own psychology as investors can actually be exploited, and just how powerful these quantitative techniques can be.
Right. The markets are driven by human behavior, and that behavior, well, it can be pretty predictable sometimes, even when it seems irrational.
Yeah, and that's what really jumped out at me in Kestner's research, this idea that many investors have this tendency to sell winning investments way too early, but then they hold on to losers for way too long.
It's a classic bias.
It's almost like we're afraid of losing out on potential gains, but we're also terrified to admit we made a mistake.
Yeah. Terence O'Dean, he did a lot of research on this. His work really highlighted this bias. But what I find interesting is that quantitative trading actually aims to exploit these very human tendencies.
It makes you wonder if we're all just pawns in their game?
Well, it's not quite that simple. But it does show how important it is to be aware of these biases, even if you aren't a quant yourself.
Absolutely. So what really stood out to you in Kestner's research in terms of how quants actually take advantage of this selling winners thing?
One of the most interesting things is just how effective trend-following systems can be. And not just in one area, but across a bunch of different asset classes. Kestner looks at stocks, futures, even options. He shows how these systems can identify and ride market trends. And that has the potential to generate some serious profits.
Okay, so that's where it starts to get really interesting to me, the strategies themselves. Kestner mentions channel breakouts, moving average crossovers, momentum strategies.
Right.
I have to admit, some of it went over my head. Could you maybe unpack a couple of those for us?
Sure. Let's start with a dual moving average crossover. Imagine you're looking at a stock chart. You've got two lines on it. These represent different moving averages.
Okay.
Now, when the shorter-term average crosses above the longer-term average, that can signal a potential shift in momentum.
Oh, I see.
That could indicate a good time to buy. On the flip side, when the short-term average crosses below, it might be time to sell.
So you're looking for that crossover point as a trigger, basically.
Exactly.
Hmm.
Kestner also dives into volatility breakouts. This strategy focuses on those times when a stock's price makes a big move outside of its normal range.
Kind of like those outlier days on a chart, right? The ones that make you go, whoa, what just happened?
Precisely. Those big price swings can be a sign that a new trend is starting. And for traders, it's a chance to jump in and ride that wave.
But wouldn't that be super risky?
Yeah.
I mean, jumping into a stock that's suddenly making huge moves like that.
That's where risk management comes in. A lot of quantitative traders use stop-loss orders. It's like setting a safety net for your trades.
So you're limiting your downside while still giving yourself a chance to capture those big moves.
Exactly. That's the art of quantitative trading, finding the right balance between risk and reward.
I also found it interesting how Kestner emphasizes the limitations of optimization in his book, how optimizing a strategy can sometimes backfire.
Right. He shows that while it can sometimes improve performance, it can also lead to overfitting.
Right, and he gives some examples of this.
It's like tailoring a suit perfectly to your measurements, but just on a specific day. What happens if your body changes even a little bit? The suit won't fit anymore.
Makes sense.
And the same thing can happen with trading strategies. What worked great in the past might not work in the future, especially if market conditions change.
So how do quants find that balance between optimizing a strategy and avoiding the dangers of overfitting?
It's a tricky balance. You need a deep understanding of the markets, the ability to really interpret historical data, and a good dose of skepticism.
You've also got some fascinating insights from Gregorius' handbook on high-frequency trading.
Oh yeah, it's a whole other world.
It's an area that's often shrouded in mystery, and honestly, it's a bit intimidating to someone like me.
It can be. High-frequency trading has definitely become a major force in the markets. Its impact is still being debated.
Can you give us a peek into this world? What makes high-frequency trading so different from traditional trading?
So high-frequency trading, or HFT, relies on some pretty advanced technology and sophisticated algorithms to execute trades at super fast speeds.
Super fast. How fast are we talking?
We're talking milliseconds or even microseconds.
Yeah. I can't even imagine.
It's mind-boggling. So speed is definitely key. HFT firms invest a lot in infrastructure, powerful computers, servers located right at the exchanges, low latency connections, all to make sure they're as fast as possible.
Makes sense. So it's all about speed then.
Speed is crucial, yeah.
Mm.
But it's not just about being fast. It's about using that speed to take advantage of these really fleeting market opportunities.
What kind of opportunities? I mean, they must appear and disappear in the blink of an eye, right? If they're being exploited at those speeds.
Right. One common strategy is market making. Basically, HFT firms provide liquidity to the market by constantly placing bids and offers for different securities.
So, like, they're middlemen, facilitating trades between buyers and sellers.
Exactly. And they profit from that tiny difference between the bid and ask prices, the bid-ask spread.
Ah, so it's a volume game then, making small profits on a huge number of trades.
That's right. And they leverage their speed and technology to make this process as efficient as possible. They're always adjusting their bids and offers, trying to capture those tiny profit margins.
But it's not all about market making, is it? There are other strategies in this high-frequency world.
Yeah, definitely. Another big one is arbitrage.
Right, arbitrage. That's about exploiting price differences, right?
Yeah. It involves finding those tiny price discrepancies for the same asset, but on different exchanges.
So they're buying low on one exchange and selling high on another, all in a fraction of a second.
Exactly. It's not a new strategy, but HFT firms use their speed and tech to do it at a whole new level.
It sounds incredibly complex and risky.
Yeah, it's a high-stakes game.
And speaking of risk, what are some of the potential downsides of high-frequency trading? I have to admit, this is where things get a little unsettling for me.
It's understandable. One of the biggest concerns is fairness. Critics argue that HFT firms have an unfair advantage, because of their speed and technology. They can essentially see orders coming in from other traders before anyone else, which gives them a serious edge.
That does raise some questions about whether everyone is on a level playing field. What other concerns are there?
There's also the potential for market manipulation.
Ooh, that sounds scary.
Mm.
What exactly do we mean by manipulation in this context?
Well, some people worry that these firms could use their technology to create false signals or to front-run large orders and basically influence prices to their advantage.
So they could be manipulating the market for their own gain.
That's a concern that regulators are looking into.
And then there's the systemic risk we talked about.
Right.
That idea that high-frequency trading could be making the markets more fragile and more prone to crashes.
Right, because HFT firms trade in such huge volumes and at such incredible speeds, their actions can actually amplify market moves, both up and down.
Right.
This can lead to a herding effect, where other traders start reacting to these rapid-fire trades, and that can make the volatility even worse, increasing the chance of these sudden sharp drops or spikes in the market.
So, like a domino effect. One firm's actions can trigger a chain reaction throughout the whole market?
Exactly, and that's what makes systemic risk such a worry. It's not just about individual firms losing money. It's about the potential for a wider market disruption that could impact everyone.
The 2010 flash crash is a perfect example of that, right?
It is.
The market plunged almost 1,000 points in just minutes.
Yeah, and while we don't know the exact causes of the flash crash for sure, many experts believe that HFT played a part in making that sell-off worse. It turned what could have been a relatively minor market glitch into a major event.
It definitely makes you think about the interconnectedness of the markets and the potential for unintended consequences.
It does. It also highlights why it's important to keep talking about high-frequency trading and its role in our markets.
For sure. It's a conversation that we need to keep having.
Yeah.
Yeah, it really is. It's a lot to consider. As we dive deeper into this world of quantitative trading, I keep thinking about how much of the average investor's behavior is factored into these algorithms.
Right. It's a little unnerving.
Yeah, it really underscores the importance of understanding how these things work, even if you're not a quant.
Absolutely. Knowledge is power.
Okay, so let's dig a little deeper into those high-frequency trading strategies. I know Gregoria's handbook goes into some pretty interesting detail about all the different types out there. What else can you tell us about how these firms are using algorithms to, well, basically get ahead?
Well, we've talked about market making and arbitrage, but there are also these directional strategies
Okay.
where the firms are actually making bets on which way the market's going to move, kind of like traditional traders do.
So they're not just profiting from the spread or tiny price differences. They're trying to predict where the market is going.
Exactly. They might use algorithms to spot those short-term trends or those momentum shifts. They're aiming to capture those price movements.
But they're doing it at lightning speed, right?
That's the key. They're leveraging their technology to analyze huge amounts of data, spot those tiny opportunities, and then execute trades, all within fractions of a second.
It's hard to even wrap my head around how complex these algorithms must be. What are some of the things that go into creating a successful high-frequency trading strategy?
It's a challenge, for sure. I mean, obviously, speed and technology are huge,
Yeah.
but you also need really strong statistical models, a deep understanding of how the market works at that micro level,
Yeah.
and you got to be able to adapt to those constantly changing conditions.
And I bet risk management is even more important here, right? I mean, with things moving that fast.
Oh, absolutely. Risk management is crucial in any trading strategy, but especially in the high-frequency world. These firms have to use some very sophisticated risk controls to keep an eye on their positions, manage exposures, and limit those potential losses.
So, a whole other level of complexity. Gregorio also dives into the whole debate surrounding high-frequency trading. It's not all positive, is it?
No, it's a complex issue, and there are strong arguments on both sides.
What are some of the arguments in favor of high-frequency trading?
Well, some people argue that it's actually made the markets more efficient. We've got tighter spreads now, there's more liquidity. They say it's reduced trading costs for everyone.
So they're making the market more accessible, cheaper to trade.
Right. And they also talk about its role in price discovery. Because these firms are constantly crunching data and adjusting their bids and offers, they're helping the market find that true value of a security more efficiently.
So they're helping the market find the right price faster.
Exactly. But of course, not everyone agrees.
Right. You mentioned earlier that there are some concerns about fairness, manipulation, systemic risk. Let's break those down a bit more. What are some of the downsides that people are worried about?
Okay, well, one of the big ones is this idea that it creates an uneven playing field. Critics say HFT firms have an unfair advantage over everyone else simply because of their technology. They can basically see into the future.
Yeah, it sounds a bit like a cheat code.
Yeah, it can feel that way. It raises a lot of questions about fairness. And then there's the whole issue of market manipulation. We have rules in place to prevent it, but there are still worries that these firms could use their tech to mess with prices, create false signals in the market.
What do you mean by manipulation?
Well, there's something called spoofing, for example. This is where traders place these huge orders that they have no intention of actually executing.
So they're not real orders.
No. They're hoping to trick other participants into pushing the price in a certain direction.
So they're making it look like there's more supply or demand than there actually is.
Right. And because everything happens so fast with HFT, it's tough to detect and stop this type of behavior.
It's a real challenge for regulators to keep up.
It is. It's like a constant cat and mouse game.
And then there's that systemic risk we talked about, that high-frequency trading could actually be making the market more fragile, more prone to crashes.
Right. Because HFT firms trade in such massive volumes and at such high speeds, what they do can really amplify those market moves, both up and down. And that can create a kind of herding effect where other traders see these rapid-fire trades and react to them, and that can make the volatility even worse, potentially leading to those sudden sharp drops or spikes in the market.
So it's like a domino effect. One firm's actions can trigger a chain reaction that affects the entire market.
Exactly. That's why systemic risk is such a big concern. It's not just about individual firms losing money. It's about the potential for a wider market disruption that could affect everyone.
The flash crash in 2010 is a good example of that, right?
Yeah. The market dropped almost 1,000 points in just a few minutes. And while people still debate the exact causes, a lot of experts think HFT played a part in making that sell-off so much worse. It turned a minor market blip into a major event.
It's a reminder of how interconnected everything is and how even small actions can have unintended consequences.
Absolutely. And it just shows why we need to keep talking about high-frequency trading and how it affects our markets.
So shifting gears a little bit, I want to go back to those quantitative strategies that Lars Kestner talks about in his book.
Okay.
It's one thing to understand the basic ideas, but it's another thing to really get how these strategies actually work.
He is.
One of the strategies he explains is the channel breakout, which we touched on before. Can you walk us through how that actually works in practice?
Sure. The channel breakout is a trend-following strategy. It helps you identify stocks that are breaking out of their usual trading range. Think of it like this. A stock's price has been moving within a certain band or channel for a while.
So it's stuck in a range, bouncing between 2 points.
Yeah, like it's trapped in a hallway. A channel breakout happens when the price breaks above the top of that channel or below the bottom.
So it breaks free.
Exactly. And that breakout can be a signal that things are about to change. It could lead to a sustained move in the direction of that breakout.
So a trader using this strategy would look for those breakouts as a signal to buy or sell.
That's right. A buy signal would be triggered if it breaks above the top of the channel, and a sell signal if it breaks below the bottom.
Sounds simple enough. What's the catch?
Well, timing is everything. You have to be able to identify the channel boundaries accurately and tell the difference between a real breakout and a false signal.
A false signal.
Yeah, that's when a stock breaks out of the channel, but then quickly reverses, which can be bad news for traders who jumped in too soon.
So it's like a head fake. You have to be able to tell if the stock's really going to make a big move or if it's just messing with you.
Exactly. That's where experience, skill, and really understanding the market comes into play.
And I imagine risk management is crucial here too, right? You have to be ready for those fake outs.
Absolutely. Traders who use the channel breakout strategy will often use stop-loss orders, placing them just below the breakout point. That way, they can limit their losses if the breakout turns out to be a fake.
So they're protecting themselves while still giving themselves a chance to profit if the breakout is real.
Exactly.
Yeah.
That's the key to successful trading. Managing risk while taking advantage of good opportunities when they pop up.
Now, Kestner also talks about the dual moving average crossover, which we discussed earlier. What are some of the key things to think about when using that strategy?
Well, the dual moving average crossover is a popular one for trend following. It uses two moving averages of different lengths to generate those trading signals. You get a buy signal when the short-term moving average crosses above the longer-term one.
Okay.
That suggests that upward momentum is building.
So you're looking for the moment when the short-term trend starts moving away from the long-term trend in a positive direction.
Exactly. And of course, you get a sell signal when the short-term moving average crosses below the long-term one. That hints that downward momentum might be taking over.
So the key is to spot those crossovers and then ride the trend.
Yeah. But one of the things you really have to consider is which look-back periods to use for the two moving averages.
Look-back periods.
Yeah, it's basically the number of data points that you use to calculate each moving average. A shorter look-back period, like 10 days, will give you a moving average that's more sensitive. It reacts faster to price changes.
Okay.
A longer look-back period, like 50 days, gives you a smoother moving average that's not as affected by those short-term swings.
So it's a balance between sensitivity and stability.
Right. Finding the right look-back periods depends on how you like to trade, your risk tolerance, and the specific market you're trading.
So there's no perfect formula that works for everyone.
Nope. You often have to experiment to find the settings that work best for you.
Once you've got your look-back periods figured out, you just buy when the short-term average crosses above the long-term one and sell when it crosses below.
Basically, yes. But remember, no trading strategy is perfect. Those false signals can happen, and markets don't always move in predictable trends.
Risk management is always important.
Definitely. You need to have a plan for handling losses, whether that's using stop-loss orders, setting limits on how much you invest, or diversifying your portfolio.
It seems like quantitative trading, for all its complexity, still comes down to some basic ideas. Understanding the market, managing risk, and being able to adapt to those ever-changing conditions.
That's a great way to put it. Whether you're a quant or not, successful trading is about discipline, patience, and respecting the power of the markets.
Yeah, it really is fascinating how these complex strategies often just come back to those basic ideas. Now, Kestner also talks about some other interesting techniques, like momentum trading. What's the main idea behind that one?
Well, momentum trading is based on this idea that stocks that have been moving really strongly in one direction are likely to keep moving that way, at least for a while.
So it's like jumping on a train that's already moving and hoping it doesn't stop.
Yeah, that's a good way to put it. Momentum traders try to ride those waves of market sentiment. They buy stocks that are showing strong upward momentum and sell the ones that are lagging behind.
But wouldn't that make you super vulnerable if things suddenly reverse? What if the train suddenly changes direction?
There's always that risk. That's why momentum traders are really strict about risk management. They use stop-loss orders to limit their losses if the trend reverses.
So you're trying to balance that potential for big gains with the need to protect your money.
Exactly. Momentum trading can be really powerful, but you need discipline and a good understanding of what's happening in the market.
And speaking of market dynamics, Kestner also talks about volatility, how it plays into quantitative trading strategies. What did you learn from his research on that?
Volatility is a big deal for quants. Some strategies, like that volatility breakout we talked about, actually target those times when volatility is high. They're trying to profit from those big price swings.
So they're not afraid of volatility, they're actually using it to their advantage.
Yeah, exactly. They look for those moments when the market's all over the place because that's where they see the potential for big gains.
But doesn't that mean more risk, too?
It does. Volatility can work both ways, so anyone using a strategy that involves volatility really needs to pay attention to risk management. Traders might adjust their position sizes or use options to hedge their bets so they can reduce potential losses while still having a chance to profit from those big moves.
It's all about finding that balance. Now, there's another technique Kessner mentions, the M80 histogram retracement system. Can you tell us a little bit about that one?
Okay, so the M80 histogram is this popular indicator that basically measures the difference between two moving averages. The retracement part of the strategy means looking for those times when the histogram pulls back from an extreme reading. That could be a sign that momentum is shifting.
So it's like you're looking for those points where the market might be overbought or oversold and maybe ready for a reversal.
Yeah, that's a good way to think about it. Traders who use this technique try to anticipate those turning points in the market, and they use the MESED histogram to help them.
It sounds like quantitative trading is like putting together a puzzle. You're always combining different indicators, strategies, and risk management techniques to build a system that works for you.
That's a great analogy. There's no one magic formula. It's about understanding the principles and then figuring out how to apply them to your own trading style and how much risk you're comfortable with.
So it's about building your own toolkit.
Right. And knowing which tool to use in different situations.
Before we wrap things up, I wanted to touch on one last thing I found really interesting, the future of quantitative trading. Where do you think this is all headed?
That's a great question. I mean, technology is changing so fast, right? We're going to see even more sophisticated algorithms, faster trading speeds, and completely new ways of analyzing data.
Yeah.
Artificial intelligence and machine learning are already playing a role.
Yeah.
I think we're just going to see more and more of that in the future.
It almost feels like we're entering this new era of trading where it's harder to tell where the human ends and the machine begins.
Yeah, it's an exciting time to be involved in this.
Yeah.
But it does make you think about some important questions. Like what's the role of humans in the markets going forward? What are the ethics of algorithmic trading? And do we need stronger regulations to make sure everything's fair and stable?
Yeah, those are questions we need to keep thinking about.
For sure.
Well, this has been a really insightful look into the world of quantitative trading. We've talked about so much, from the biases that affect investors to those super fast, high-frequency trading strategies and the impact they have on the market. It's been great.
It has.
And, I think the big takeaway for our listeners is that quantitative trading, even though it can seem really complicated and intimidating, it all boils down to using data, logic, and good risk management to navigate the markets. Whether you're a pro trader or just interested in understanding how the financial world works, there's something here for everyone.
Definitely. I think it's so important to keep learning, keep exploring, keep asking questions. This field is constantly changing. There's always something new to learn.
Well, thanks for joining us on the deep dive. We hope you learned something new and got a glimpse into this fascinating world of quantitative trading.
And until next time, happy trading.